What's up, guys? Welcome to Bullish Bets. On this channel, we cover all things related to stocks and investing. We take a look at potential big bets and see if some of the YOLOs are justified or not. Today, we're going to talk about FUBO. Let's talk about this sports streaming service. They're a streaming service that focuses on sports, and they're getting into online gambling. This is a big move since DraftKings is killing it right now. Keep in mind that we are not financial advisors and this video is for educational and entertainment purposes only. Make sure you do your own research before making any investment decisions. If you guys might have known, FUBO had a big move. After earnings report yesterday, expected earnings from Q4 were at negative 74 cents per share, but the actual earnings came out to negative $2.47 earnings per share. They missed earnings by $1.74. This is huge. The price dropped from by around $6.50 to $35 and around 40 cents ish as the time I'm recording this, which is about 15%. Although this is not a huge drop, as the optics of the misleading earnings, that could have been much worse. Earnings miss around $1.74 is huge, and I'm surprised it didn't drop more. Usually, when a company shows such a huge miss in earnings per share, it's scary. But if we dig closer to see what's going on with FUBO, they're not burning through money just due to horrible operations. FUBO seems to be going with the mindset of growing fast no matter what. No matter how much cash they burn, they want to grow. They gained 92,000 subscribers in the fourth quarter alone, which leaves them with around 550,000 subscribers by the end of 2020. The revenue that potentially comes in from subscriptions is around 91 million, and they made 13 million from advertising. They increased their subscription revenue by 100% in Q4 compared to Q1, Q2, and Q3 combined. They're growing fast and it looks great, to be honest, but they're just burning through some cash for this growth. As they get more subscribers, they can increase their ad revenue, and it looks good because subscribers related expense is lower in Q4 2020 compared to the whole of 12 months. Their cost per subscriber is going down. This means they're decreasing their cost of goods sold essentially. And since that is what it means, since that's what it means for the subscription model, keeping the subscriber cost down is potentially big in bringing FUBO into positive earnings. Since it's a subscription-based company, FUBO has to pay an upfront cost for marketing to secure a subscriber, but once they secure a subscriber, they're more likely to stay if they prefer the service, and they don't have to spend on that acquisition of customer costs anymore. So the more subscribers that FUBO can get, the more they can decrease their operating expenses in the future. The stock may continue to drop and dip, as they do show a huge loss in 2020. This will lead to some bearish players within the short term, and this potentially can mean there will be a short squeeze in the future. The more shorts there are on a company that doesn't look good in the optics but are really strong fundamentally will lead to a potential short squeeze because people don't want to sell out of good companies. The short interest did decrease from around 16% from 23% as of February 12th. But with the bad earnings call that happened yesterday, the short interest will most likely go back up. FUBO has a small float, around 91 million, and it has a relatively high volume for its float. This is the prime environment for a short squeeze, and it just might happen. Let us know what you think. Do you think there will be a potential short squeeze for FUBO? Are you looking to buy the dip? let us know in the comment below. If you liked our content, please subscribe and hit the like button. This will help us with the YouTube algorithm. Thank you guys again very much for watching, and stay tuned for the next one.